Does using stops in pair trading kill profitability? Stay tuned. Hey traders, warm welcome to you. Alright, so we know that using stops when you are modeling or backtesting something really kills the profitability of a system. You know, stops are really not very good for profitability. However, they are really a necessity when we're trading in the real world to stop us blowing up an account. So it's that kind of, what do we do with it? How do we place the stops? That's why many people with short-term trading, we have to use stops, but you know, we've got to give them enough room so the market can breathe. So we're trying to find that sweet spot. Now, when we're pair trading, things are a little bit different because we're pair trading, we're not trading directional play, we're literally trading one instrument against another. So we could be trading one mobile carrier against another mobile carrier, one video games software provider against another video game software provider, one supermarket against another supermarket, one oil company against another. If someone in the same sector, delivery company, you get the idea. The idea is the same sector, the same market, the same everything's affecting the business, or both businesses, should I say, and you're trading as the price starts to move away from each other. So if we had this chart plotted here of the ratio of the two, now if the whole market moves up and these two move up together, the ratio is going to stay the same. If they move down together, the ratio is going to stay the same. If one starts to outperform the other, then the ratio is going to move up or down depending on which one we're dividing against each other. So the theory of a pair trade is that as it gets out of sync and gets to a certain point, we take a pair trade. So we start to short. We short one and we buy the other. And if you're brand new to pair trading, then maybe go and check out some other videos I've done on the channel. We talk about some of the intricacies and how to actually place the pair trade. But this is more looking at, you know, the stop aspect, the risk management aspect of it. Now, the reason I do this video is I was thinking about a time where I was in the US and I met with a guy who was a prolific pair trader. That's all he did. He just traded pairs on the US exchanges. Wealthy man, had a lot of a big account size, and he never used stops. And he would always stay in the position. Now, what he would do is as the pair trade got to his level, let's say this was level 1, okay, he would put on a chunk of his position. That's a 1. He would put on a chunk of his position, and it always would be a mean reversion play, of course, because a pair trade, you're looking for the market to come back to its mean. So you're looking to buy one and sell the other, and the expectation is that they converge back again, you sell the trade. Now, if the market then, so in this example here, that would be a great trade. He'd then take the trade in the opposite direction. That'd be a great trade. So it'd be like 1, 1, 1, 1. In this situation, he'd take the trade, and let's just extend that a little bit just for this example. He'd take the trade here, but if it went again a little bit more, he would add to the position. So he'd add another chunk to the position here, and then if it went even more, for example, he'd add more. He'd have layers where he would add another layer on. And he would never stop out of a position, or very, very rarely. You know, I think maybe he did, you know, once every now and then he would just cut the position because something had changed fundamentally. And that's the key thing we'll get to in a moment. So he would add to this position, and then as the pair would come back, he'd scale out of that layer. He'd add more on, he'd scale out there. So he had a very dynamic position. So he'd add as it came back. He'd take that chunk off, goes out again, he'd take that chunk off. If it came back again, he'd still have the big position on. So he would never ever stop out of a position, except in rare circumstances, like I say, which we'll address in a second. Now, that sounds great on paper because you're trading a very, very mean reverting product, which is the, you know, the ratio between the two. You're not trading a directional play like the market and adding, which ultimately the market could just rip into a trend for the next few years and just clean you out. You're trading something that's market neutral, it's sector neutral, and has a mean reverting tendency generally. Yes, they can uncouple and you can have the ratio, but argument is that he's protecting himself against that because he's adding in and adding in. So even if this mean were to shift, and obviously if we were trending more, it would be more, we'd kind of have the angle, it wouldn't be straight lines like this, but just for illustration purposes, and the mean would start to move up. But the argument is that if he's always trading at the extremes and back in, then he's going to make that money back. Now, the downside, of course, is that your loss can be unlimited here. You know, you can be adding and adding and adding and adding and adding and layering in, and you've got a kind of 10 layers in, and you're down on the trade, and you're in a trade that really is not working. And there's a possibility, and of course, and there were times when you'd have multiple layers on. But the issue I think you've got, and this is why we're kind of got to be open-minded a little bit about different ways of approaching the market, guys, is that he wouldn't trade, his first layer wouldn't be a massive amount. He was well capitalized, so he could probably add 10 layers to a trade and still be okay. He probably didn't want to be that much as it is, but let's say he was adding one layer, and most of the time he maybe add 4 layers maximum, and then if you had to go to 10, that may be it. But that going to 10, if you think about what is actually happening, it's not pulling back enough for him to take off one layer, so it's just going in a straight line for 10 consecutive standard deviations, if you like, or whatever kind of gap you say. So in a mean reverting product like a pair trade, that's super unusual. Of course it can happen, but if your layers are thick enough and wide enough, that's a long way to go, and it would probably indicate that maybe a company's going bust and the other one's taking an opportunity there. And that's why we go back to the point of the only time you would stop out is if there was a fundamental reason, like, oh, this company's going under. Okay, so that means that the whole thesis of the pair trade is no longer valid. I need to just take the loss, and that's rare. It's going to be obviously rare. If it's just a company that's struggling short term, the expectation is that they'll win some market share, they'll win some market share back. The charts will make themselves kind of rectify themselves again. So this guy was adding. So obviously, the downside of that is that you can be caught in something that's really bad. The upside of that is that you're trading a mean reverting product, and if you're adding to it, then the probability of success is quite high. You've got to not go in too heavy, and I think the lessons we can learn from it are this. You're not going too heavy on the first add, having your layers wide enough so that you're not going crazy, you're not in a massive position size when it's just getting going, but also respecting the fact that the market can do that and having a plan for that. And we can take that from that even if we don't pair trade. Having a plan for how will I react if it just goes against me massively? Will I cut the position? Will I add to the position? How will I do it? And I think the secret to this guy's success is, the issue we have is with pair trading, it kills profitability, stops kill profitability, because the mean reverting tendency means that you end up stopping out when it's the very best trade. And I know we've got to understand the risk management as well with this, but ultimately, when the market, has gone to here, it's really good opportunity. If you look at it from the hypothesis of, well, the value's still there, they're just literally out of sync. And if you're coming out into this, if you're stopping out, say you went short here on the pair and you stopped out here, you're probably taking it off at the better opportunity, assuming the thesis is still valid. And so, using stops in pair trading can kill profitability, because you're trading literally against the reason you're taking the trade. And so thinking about layering into these pair trades, it's not for everybody, it's definitely the case, because the open-ended risk here, and you can get caught out, but I definitely don't recommend it for kind of newer traders. I think that stops are essential for newer traders to prevent blow up. But someone with a large account, someone with experience, someone who understands how far these things can go, has a scaling strategy, has an exit strategy, has a very defined process, then can take advantage of this kind of thing, and can take advantage when you've got a month or so when it's out of sync, and then it comes back in, takes the profit off the table. So back to the initial point, guys, using stops in pair trading, does it kill profitability? Yes, it does. And that's why many pair traders are very well capitalized and are layering into trades. But I want to highlight this because, it really kind of proves a point that, yes, we must use stops. We must kind of manage risk, but we don't have to use stops all the time. You can manage risk in a different way, and managing risk with size is another option. As long as you're not going too big and you're in an instrument that's not going to suddenly rip off. Of course, anything can happen with the markets, but a pair trade, unlikely just to suddenly kind of gap up massively and kind of rip your face off. And so leveraging on that and accepting the risk comes out with a reasonable, profitable strategy. All right, guys, that's something to think about. Pair trading, stops, entering, exiting, layering in, adding to the trade. Take care. Bye-bye.